Imagine opening your banking app tomorrow morning and seeing that your net worth has just jumped by 20% overnight.
That would be a pretty good morning.
Right. Your initial reaction is probably elation. You start thinking about early retirement or maybe upgrading your car. But then you look a little closer at the ledger and you realize you don't actually have a single extra dollar of cash in your checking account to spend.
Ah, the catch.
Exactly. Your wealth increased entirely on paper just because the theoretical market value of assets you already own and have no intention of selling suddenly skyrocketed.
It's a classic paper millionaire scenario.
It is. Welcome to the deep dive. Today we have a document on the table that mirrors that exact scenario, but on a macroeconomic sovereign scale.
Yeah, we are getting into some heavy machinery today.
We are looking at Chapter 12 of the Reserve Bank of India's annual report for 2025-26. Specifically, we're diving into the central bank's accounts.
And, it's a document that on its surface looks like a standard corporate financial statement, but it actually operates under a completely different set of, well, physical and economic laws.
Right. So if you are joining us today, you are likely prepping for a high-stakes professional examination. Or maybe you're a financial analyst trying to cut through the density of central bank reporting.
Which is notoriously dense.
Extremely. So consider this your exhaustive analyst-to-analyst briefing. Our mission is to tear apart the mechanics of this balance sheet so thoroughly that you inherently understand the architecture.
We aren't just going to memorize figures here.
No, definitely not. We are going to understand the underlying economic realities that, force the numbers to behave the way they do.
Because that's what the examiners actually test. They test the why.
Exactly. So we are going to look at a massive 20.6% explosion in the RBI's balance sheet size. And we are also going to dissect a jaw-dropping 102.4% spike in reported expenditure.
Which, spoiler alert, is actually masking a really vital capital protection mechanism.
Right. So the difficulty with Chapter 12, and the reason it is so heavily tested, is that it sits right at the intersection of accounting policy, international monetary dynamics, and strict statutory mandates.
Yeah, if you try to apply standard corporate finance logic to this document, you will inevitably misinterpret the data.
100%. So my goal today is to help you build the correct analytical framework. We'll unpack the why behind these accounting treatments.
And crucially, we'll point out the specific analytical missteps that novice analysts and, well, people sitting for these exams tend to make.
Right. And I want to set a ground rule right now. We will explicitly call out key exam takeaways throughout this entire discussion.
So you don't even need to read the source text to pass with flying colors.
Exactly. Let's start right at the top with the macro view. The headline figure that just jumps right off the page is the sheer scale of the balance sheet expansion.
That's massive.
It is. The RBI's balance sheet size increased by 15,071,699.1 fixed crore. That is a 20.6% year-on-year growth, bringing the total to a staggering 91,097,121.08 crore as of March 31st, 2026.
Roughly 91.97 lakh crore. And, to ground that number in reality, the balance sheet size now stands at 26.4% of India's gross domestic product.
That's up from 23.7% the previous year, right?
Right. So that represents a massive expanding footprint on the national economy.
And this is where that corporate comparison we talked about completely breaks down. Like, if a multinational corporation's balance sheet inflates by 20% in 12 months, what do we assume?
You assume they acquired a major competitor or, issued massive amounts of debt.
Right. Or they built physical infrastructure across the globe. Corporate asset growth usually implies operational expansion.
But when we look at the asset drivers for the RBI, the composition tells a completely different story.
Tell me about it. Domestic investments were up 44.9%. But the real outlier?
Gold.
Gold was up an incredible 63.8%, and foreign investments were up 7.9%.
The composition ratio is perhaps the most critical structural feature to lock into your mental model right now.
Okay, let's lock it in.
The report explicitly states that total asset composition sits at 29.1% domestic versus 70.9% foreign currency, gold, and loans outside India.
Key exam takeaway right there.
Yeah.
Nearly 71% of the central bank's assets are outward facing.
Exactly. And that dictates the entire risk profile of the institution. They are fundamentally exposed to global market dynamics far more than domestic ones.
So let's get back to that 63.8% surge in gold assets. Because if I'm a candidate looking at a multiple choice question about what drove the RBI's asset growth, my immediate intuitive trap is to assume they just went on a massive bullion buying spree.
It is the most common pitfall. I mean,
Well,
people see a 63.8% increase in the value of gold assets and just naturally assume a corresponding increase in physical volume.
right, but that's not what happened.
Not at all. The report clearly details that the physical volume of gold increased only marginally, from 879.58 metric tons the previous year to 880.52 metric tons by March 31st, 2026.
Wait, really? They added less than 1 metric ton of physical gold.
Less than 1 ton.
Wow. Which means this massive expansion is almost entirely a valuation effect. It's that banking app scenario we opened with.
Exactly. The RBI didn't buy the wealth. The
Yeah.
environment shifted around them to make what they already held look vastly more valuable on paper.
So what exactly shifted in the environment?
Well, we have to look at the two distinct macroeconomic forces that altered the printed numbers. First, the global price of gold, which is, denominated in US dollars.
Right, and that saw a significant surge during the 2025-26 period.
It did. And second, the Indian rupee depreciated against the US dollar over that exact same time frame.
Ah, so it's a compounding effect.
Perfectly said.
Yeah.
The asset became more valuable in dollars, and then those dollars became more valuable in rupees when translated back for domestic reporting.
That dual force mathematically inflates the asset side of the ledger. But, double entry bookkeeping is an absolute law.
A balance sheet must balance.
Right. So if the asset side suddenly inflates by hundreds of thousands of crores purely on paper, you have to create a corresponding entry on the liability side to keep the ledger stable.
And that is exactly where the liability drivers come in.
Right. The report shows revaluation accounts skyrocketed by 63.4%, perfectly mirroring that paper gain on the assets.
Notes issued grew by 11.8%, deposits grew by 11.6%, and other liabilities jumped by 21.1%.
That's the revaluation accounts are really the heavy lifter here.
Oh, absolutely. So if someone is trying to isolate the core exam takeaways from this macro overview, it really comes down to a few things.
Let's lay it about.
First, memorizing that 91.97 lakh crore total. Second, understanding that 70.9 to 29.1% outward-facing asset split.
Key exam takeaway.
And third, recognizing that the primary growth driver was valuation, specifically gold on the asset side, and revaluation accounts on the liability side, not physical acquisition.
That is the exact baseline you need. And understanding that mirroring effect leads us directly into the engine room of central bank accounting.
The revaluation accounts themselves.
Right. Because if you don't understand how these accounts function, you literally cannot accurately interpret the RBI's financial health.
It's impossible.
So the primary account in this category is the CGRA, the currency and gold revaluation account. And the numbers here are just staggering.
They really are.
The CGRA surged from 13.02 lakh crore at the end of the previous year to 21.68 lakh crore by March 31st, 2026.
We're looking at an increase of over 8 lakh crore in a single year.
Insane. And there's also the introduction of the provision for forward contracts valuation account.
Right, the PFCVA.
Yeah, which is currently sitting at 43,403.23 crore. But before we get into the weeds of forward contracts, let's establish the ground rules for how these valuations are actually calculated.
Because the specific frequency of these valuations is prime fodder for exam questions.
Exactly. I've seen it tested so many times. The report dictates very specific accounting policies for translation.
Foreign currency assets and liabilities are translated daily at prevailing market rates.
Daily.
Gold, however, is translated monthly, specifically on the last business day of the month.
Key exam takeaway right there.
Yeah.
But why the disparity in frequency? Like, why mark foreign currency to market every single day, but only check the value of gold once a month?
Well, it comes down to the nature of the markets and the purpose of the assets.
Makes sense.
Foreign exchange markets are hyperliquid, deep, and continuous. The RBI is actively managing foreign currency liquidity daily.
So daily translation captures that real-time operational exposure.
Exactly. Gold, conversely, acts as a long-term strategic reserve, a fundamental store of value. The internationally accepted standard for central banks is often to market based on a standardized, widely recognized monthly benchmark.
Right. And for the RBI, they use the London Bullion Market Association, or LBMA, PM fix. Let's briefly define that for absolute clarity. The LBMA PM fix is basically the globally recognized afternoon clearing price for gold in London, right?
Correct. It sets a standard dollar price per ounce. So institutions around the world are working off the exact same sheet of music.
But since the RBI operates in rupees, they have to translate that dollar benchmark.
Right, and they do this using the financial benchmarks India Private Limited, or FBIL, reference rate.
Okay, FBIL.
So at the end of every month, they take the LBMA dollar price of gold, run it through the FBIL rupee dollar exchange rate, and that final number dictates the new value of their 880.52 metric tons on the balance sheet.
Which brings us to the trap that examiners absolutely love to set. Let's return to the real estate analogy for a second.
Okay, let's do it.
If my house appreciates by $100,000, my personal balance sheet looks great. But that is an unrealized gain.
Right, you haven't sold the house.
Exactly. I can't use that $100,000 to buy groceries unless I sell the property. So when the RBI's CGRA surges by 8 lakh crore, a novice analyst might look at that and say, wow, the RBI just made an 8 lakh crore profit this year.
And if they select that option on a test, they fail the question immediately.
It's brutal.
The CGRA represents purely unrealized gains. It is not realized profit. And more importantly, it is not available to be transferred as a dividend or surplus to the central government.
What would actually happen if the RBI treated that 8 lakh crore paper gain as actual profit and transferred it to the government?
I mean, it would be a disaster. They would literally have to print 8 lakh crore new rupees just to hand over to the government because the actual asset, the gold hasn't been sold to generate cash.
Oh, wow. So pumping that much newly created money into the economy based purely on an unrealized asset appreciation.
It would be catastrophically inflationary. It would completely destabilize the currency. So the CGRA exists specifically as a holding pen on the liability side to neutralize these paper gains. That way, they do not hit the income statement and create a false distributable profit.
A holding pen. That is a really great way to visualize it. Now let's pivot from valuation to how the RBI classifies specific market operations, specifically repos and reverse repos.
This is a tricky area.
It is. The text makes a subtle but absolutely critical distinction between how these are treated depending on whether they are foreign or domestic operations.
Yeah, this is one of the most technical areas of the chapter, and it requires a really solid understanding of the underlying cash flows.
Let's look at foreign reserve management first.
Okay, so when the RBI engages in foreign repurchase or repo transactions, they are treating it as a borrowing of foreign currencies. This is recorded under deposits on the liability side.
Okay, borrowing.
Conversely, foreign reverse repo transactions are treated as lending of foreign currencies, and that sits under loans and advances on the asset side.
Wait. I need to make sure I am visualizing the flow of assets correctly here.
Sure.
If the RBI executes a repo in the foreign market, they're borrowing.
Yes.
But if we look at domestic liquidity adjustment facility or LAF operations, the report states something completely different.
It does.
It says LAF repo and marginal standing facility are treated as lending, shown under loans and advances.
Right.
And LAF reverse repo and standing deposit facility are treated as deposits, shown under deposits others. So for foreign operations, a repo is borrowing. But for domestic operations, a repo is lending.
I know, it sounds crazy.
How do we make sense of this apparent contradiction?
Well, the contradiction disappears when you look at the primary objective of the central bank in each specific market.
Okay, break that down for me.
In the domestic market, under the liquidity adjustment facility, the RBI acts as the ultimate provider of liquidity.
Right, the lender of last resort.
Exactly. When commercial banks need cash, they come to the RBI. The banks pledge their government securities as collateral, and the RBI gives them cash. So from the RBI's perspective, they are extending credit. They are lending rupees to the domestic system. Therefore, a domestic LAF repo is a loan, which is an asset.
Okay, so domestic repo equals injecting liquidity into the system, which means the RBI is lending. That makes perfect sense.
Now flip to the foreign reserve management side. The RBI is not the central bank of the world, right? They don't issue US dollars.
Obviously.
So in the international market, they're essentially an institutional investor managing a portfolio. If the RBI needs short-term dollar liquidity for operational reasons, they might take some of their foreign sovereign bonds, like US treasuries, and pledge them in the international market to borrow dollars.
So in this scenario, the RBI is the one asking for cash.
Precisely. They are borrowing foreign currency. Therefore, a foreign repo is a borrowing operation categorized as a deposit or liability.
That is incredibly clarifying. The definition hinges entirely on the direction of the cash flow from the RBI's perspective.
Exactly. Are they the ones providing the cash, or are they the ones seeking the cash?
So if an exam question simply asks, How is a repo transaction classified on the balance sheet? Without specifying the market, it's essentially a trick question.
It is a trick. Usually in standard domestic banking exams, if they don't specify, they are implicitly testing the domestic LAF definition where a repo is lending.
Right, because that's the day-to-day for a domestic bank.
However, a rigorous high-stakes exam will specify. The key exam takeaway for anyone studying this section is to rigorously parse the context. Domestic LAF repo is an asset. Foreign reserve repo is a liability.
Domestic repo is an asset, foreign repo is a liability.
Got it. You also need to lock down the valuation frequencies we discussed. Gold is marked monthly, foreign currency is marked daily.
Another huge takeaway.
And most importantly, deeply internalize that the massive balance in the CGRA represents unrealized gains that are strictly quarantined from the distributable income statement.
Quarantined paper wealth. I love that. Let's move from that to the actual realized money. Segment 3 of the report covers income generation.
This is where it gets fun.
We've talked about where the wealth sits. Now let's talk about where the RBI actually generates hard revenue. The report states that total income jumped 26.4% to 4,027,684.15 crore.
A huge jump.
And when you look at the breakdown, the dominance of those outward-facing assets becomes undeniable. Earnings from foreign sources hit 3,027,655.54 crore.
Which means roughly 76% of the RBI's total income is generated from its foreign operations.
76%, wow.
Yeah, and this aligns perfectly with the asset composition we discussed earlier, where nearly 71% of the balance sheet is foreign currency, gold, and external loans.
So the sheer volume of the foreign portfolio ensures it will be the primary revenue engine.
Exactly, but volume alone doesn't explain a 26.4% jump in total income.
Right, because the text highlights a really crucial metric. The rate of earnings on foreign currency assets increased to 6.4%, up from 5.3% the previous year.
Now, jumping from 5.3 to 6.4% might sound small in the context of, retail banking.
A 1.1% difference.
Yeah, but when applied to a portfolio worth tens of billions of dollars, that 110 basis point increase generates an astronomical amount of absolute revenue.
So what macroeconomic levers were pulled to drive that kind of yield expansion in a single year?
Well, to understand that yield expansion, we actually have to look outward at the monetary policy decisions of other major central banks during the 2025-26 window, specifically the U.S. Federal Reserve and the European Central Bank.
Okay, so the global macroeconomic narrative was really defined by persistent inflation, leading to a higher for longer interest rate environment.
Exactly. Western central banks were keeping their policy rates aggressively elevated to cool their domestic economies.
Right.
Now, consider how the RBI manages its foreign currency assets. They don't just hold billions of physical dollar bills in a vault somewhere.
That would be a very big vault.
Yeah. They invest those reserves in highly secure liquid instruments, primarily foreign sovereign bonds like U.S. Treasuries, or they place them as deposits with other central banks and the Bank for International Settlements.
Gotcha. So when the Federal Reserve raises rates, the yield on newly issued U.S. Treasuries obviously goes up.
Precisely. So as the RBI's older, lower-yielding foreign bonds naturally mature, they take that principal and reinvest it into the new, higher-yielding bonds available in the market.
Oh, I see.
That is the exact mechanism. The RBI is essentially harvesting the yield generated by the hawkish monetary policy of the West.
Wow.
When the U.S. Fed keeps rates elevated, it directly and massively boosts the interest income of the Reserve Bank of India.
That is a fascinating interconnectivity. It's a perfect example of the global spillover effects of monetary tightening.
It really is.
The RBI's profitability is fundamentally tied to the inflation fights happening in Washington and Frankfurt.
Totally interconnected.
So if we distill this section down for our exam framework, the critical data points are the total income figure of roughly 4.27 lakh crore and the specific rate of earnings on foreign currency assets.
Which locked in at exactly 6.4% for the year. Key exam takeaway.
6.4%. Got it.
And, while the income side of the ledger is pretty straightforward, driven by high global yields, the expenditure side of the ledger is where the accounting gets truly counterintuitive.
Okay, which brings us to the most startling number in the entire chapter, the 102.4% expenditure surge.
This is a big one.
The report states that total expenditure exploded to 1,041,091.69 crore.
Yep.
Now, if we apply standard corporate logic again, an expenditure doubling in a single year implies catastrophic operational bloat. It implies losing control of costs entirely.
There would be a massive red flag.
Massive. But when we look at the line items for actual operational expenses, that narrative just falls apart.
Because the operational costs are actually quite restrained.
Right. The cost of printing currency notes, for instance, surprisingly fell to 4,875.20 crore,
The report actually attributes this to a reduced indent, meaning the RBI literally ordered fewer physical notes to be printed.
which likely reflects broader digitization and the, continued penetration of UPI.
Right. And agency charges, which are the commissions paid to commercial banks for handling government business, rose slightly to 4,880.05 crore.
Employee costs sat at 10,136.31 crore. They even report interest paid, which is a microscopic 2.71 crore, mostly directed to specific benevolent funds.
Yeah.
So if printing costs are down, and employee and agency costs only account for a fraction of that 1.41 lakh crore, what is driving this massive reported expenditure?
The answer lies in a single massive line item, a transfer of 1,009,379.64 crore to the contingency fund.
And this is where I really struggle with the accounting terminology.
Confusing, I know.
Why is the RBI classifying a transfer to its own safety net as an expenditure? Like, if I take money out of my checking account and move it to my savings account, I haven't spent that money.
Right, it hasn't left your ecosystem.
Exactly. It isn't an expense. So why does central bank accounting treat risk provisioning as an expenditure?
Well, to understand this, we really have to deeply analyze the Economic Capital Framework, or ECF.
The ECF.
The ECF is the foundational rulebook adopted by the RBI to determine exactly how much risk capital it needs to hold to protect the institutional balance sheet against catastrophic macroeconomic shocks.
Severe market crashes, systemic credit defaults, things like that.
Exactly. It's the legally mandated rainy day fund.
But it is bound by strict mathematical parameters, right?
Very strict. The ECF requires the contingent risk buffer, the CRB, which is primarily housed in the contingency fund, to be maintained within a specific non-negotiable band,
Which is?
between 4.5% and 7.5% of the total balance sheet.
Key exam takeaway, 4.5 to 7.5%.
And for the operational year 2025-26, the Central Board set the specific target for the CRB at exactly 6.5%.
Okay, so the safety net must equal exactly 6.5% of the total balance sheet.
Yes.
I see where this is going. We established in our macro overview that the total balance sheet size exploded by 20.6%, driven almost entirely by the paper valuation gains of gold and foreign currency.
Right. We call this the denominator effect.
The denominator effect.
The total size of the balance sheet grew massively. So if your mandated safety net is a fixed percentage of a rapidly growing denominator, the absolute size of your safety net must also grow massively just to maintain compliance.
Right. It's like a corporate mandate stating you must keep 10% of your total asset value in liquid cash. If your assets double in value overnight, you suddenly have to scramble to find a massive amount of real cash to meet that 10% threshold.
Precisely. Because the balance sheet inflated so aggressively due to the rupee depreciating and gold surging, the RBI was legally forced to take a massive portion of its actual realized income.
The hard cash it earned from those high foreign yields.
Yes. They had to shovel it into the contingency fund just to maintain that 6.5% target.
Wow.
That mandatory diversion of realized income is what generated the 1.09 lakh crore figure.
Okay, that explains the necessity of the transfer. But it still doesn't fully explain why it's labeled an expenditure on the income statement.
It comes down to the legally defined order of operations for central bank profit distribution. The RBI does not exist to maximize profit, It exists to maintain macroeconomic stability.
Right.
So before the RBI can calculate its final net profit, which is the absolute amount it legally owes to the central government as a dividend, it must first fully fund its operational costs.
Makes sense.
And crucially, it must fully fund its mandated risk buffers. From a purely accounting perspective, provisioning for the contingency fund is treated as a charge against income.
Because it reduces the bottom line distributable profit.
Exactly. It is categorized as an expense to shield that capital.
So the paper gains in gold essentially forced the balance sheet to expand,
Yep.
which triggered the ECF mandate.
Yep.
Which in turn forced the RBI to divert over 1 lakh crore of real cash income into the contingency fund. By classifying it as an expenditure, they effectively shield that capital from being swept up by the government as a dividend.
Yes. It ensures the bank remains adequately capitalized no matter how volatile asset valuations become.
That is the exact systemic architecture at work. It is an elegant, automatic stabilizer built into the accounting policies.
It really is.
So for our listeners building their mental models for the exam, You need to firmly link these concepts.
Absolutely.
Note printing costs actually decreased, making it a perfect distractor question.
Don't fall for it.
Right. But the real meat is the ECF mandate. Memorize the 4.5 to 7.5% mandated band for the contingent risk buffer.
Note that the target for 25-26 was set at 6.5%.
And understand that it was the massive 1.09 lakh crore provision transferred to the contingency fund to meet that target that drove the 102.4% expenditure surge.
If you can articulate the relationship between balance sheet expansion, the denominator effect on the CRB target, and the resulting contingency fund transfer, I mean, you understand the core narrative of this entire chapter.
Which brings us to the grand finale of the cash flow. The surplus transfer to the central government.
The big payout.
Even after covering all operational costs and shoveling 1.09 lakh crore into the contingency fund to satisfy the ECF, the RBI still ended the year with an overall surplus of 2,086,588.46 crore.
And that was transferred directly to the central government.
That is a 6.7% increase from the previous year.
It is a staggering transfer of wealth. And from a macroeconomic perspective, it is critical to acknowledge why this number is so closely watched by the market.
Why is it so crucial?
Because a transfer of 2.86 lakh crore represents a massive influx of non-tax revenue for the sovereign government. Financial analysts scrutinize this figure because it directly impacts the government's ability to manage its fiscal deficit targets.
Right. It provides capital that can be used for infrastructure spending or debt reduction without requiring the government to raise taxes or issue new sovereign bonds.
Exactly. It is a vital component of national fiscal management.
And because it is so vital, examiners will rigorously test your knowledge of the legal framework that governs this transfer.
Oh, they will drill you on it.
It is not an arbitrary decision by the RBI board. It is a strict statutory mandate. The report points to two specific, highly testable sections of the Reserve Bank of India Act, 1934.
Section 47, which deals with the allocation of surplus profits,
Right.
and Section 48, which deals with the exemption of Reserve Bank from income tax.
Okay, before we explain how those two sections interact, we should address a highly specific detail embedded in the surplus figure.
Yes, the special securities nuance.
Because it is exactly the type of minutia that appears as option C on a multiple-choice exam.
They love putting this in there.
The text notes that the total surplus includes 114.31 crore payable towards the difference in interest expenditure borne by the government, consequent on the conversion of special securities into marketable securities.
That is a classic hyper-specific distractor number. 114.31 crore for special securities interest conversion. Lock that away.
Key exam takeaway. But let's look at the broader legal interaction. Can you synthesize how Section 47, Section 48, and the ECF we just discussed all function together to produce this final dividend?
Absolutely. I like to visualize the entire process as a highly structured waterfall mechanism.
Okay, I'm picturing a waterfall.
At the very top of the waterfall, you have the gross total income flowing in that massive 4.27 lakh crore, driven primarily by the high yields on the foreign portfolio.
Right.
As the money flows down, the first tool it fills is the actual physical operational expenses.
Yeah.
Paying the employees, covering the agency charges, paying for the reduced indent of printed notes.
The standard cost of keeping the lights on.
Correct. Now, if the RBI were a standard commercial entity, the next step in the waterfall would be paying corporate income tax to the sovereign government.
Right.
But this is where Section 48 of the RBI Act intervenes. Section 48 explicitly exempts the Reserve Bank from paying income tax or super tax.
Oh, okay.
So that tax pool is bypassed entirely, preserving a massive amount of capital as the water continues to flow down.
Why did the framers of the 1934 Act include that exemption? I mean, why not just tax them?
Because taxing a central bank is essentially the government taxing its own monetary agent. It creates a circular flow of capital that is just administratively inefficient.
That makes sense.
The structural design is to let the bank operate tax-free to maximize the final surplus sweep. So, bypassing taxes, the money flows down and hits the ECF pool.
Which we just talked about.
Right. As we outlined, the ECF dictates the mandatory retention for the contingent risk buffer. Because the balance sheet expanded, the ECF pool demanded a massive diversion, that 1.09 lakh crore transfer to the contingency fund.
So the ECF takes its non-negotiable cut to ensure institutional solvency.
Yes. And finally, after operations are funded, taxes are legally bypassed via Section 48, and the ECF buffer is fully capitalized. Whatever liquidity remains reaches the bottom pool.
And what's in the bottom pool?
This is where Section 47 engages. Section 47 legally compels the RBI to sweep every single remaining rupee in that bottom pool over to the central government as a surplus dividend.
It is a mandatory sweep.
Complete mandatory sweep.
The central bank cannot decide to arbitrarily retain an extra 50,000 crore for future projects. Section 47 strictly governs the allocation of surplus profits.
Exactly. And that highlights the critical synergy between the statutes. Section 48's tax exemption essentially exists to maximize the final surplus transfer mandated by Section 47.
While the ECF sits in the middle, acting as the final institutional safeguard.
You've got it.
The waterfall analogy perfectly clarifies the order of operations. So, for exam preparation, the non-negotiables here are the exact surplus figure of 2,086,588.46 crore.
The statutory authorities of Section 47 and Section 48 of the RBI Act, 1934.
And that highly specific 114.31 crore nuance regarding special securities.
Master those parameters, and you will easily navigate any questions regarding the dividend transfer.
All right, we are entering the final major analytical block of the chapter. We need to dissect the departmental split of the balance sheet, the exact gold tonnage distribution, and a series of trick accounts that examiners routinely exploit.
These are the fun ones.
The report structurally bifurcates the balance sheet into two distinct entities, the issue department and the banking department.
This is the structural quirk of central banking architecture that, frankly, consistently confuses analysts who are used to consolidated corporate reporting.
It certainly requires a mental adjustment. The text states that the issue department is responsible for backing the currency,
Right.
while the banking department handles the general banking functions of the institution. But to truly understand this, we have to look at how the physical assets, specifically the gold, are divided between them.
Yes, the gold split is crucial.
We established earlier that the total physical gold held by the RBI is 880.52 metric tons. But it is legally segregated.
Very strictly segregated.
312.32 metric tons are held by the issue department as backing for notes, and the remaining 568.2 metric tons reside in the banking department.
Key exam takeaway.
Furthermore, the report notes that the value of the gold in the issue department specifically surged 64.1% to 3.8 lakh crore.
The segregation of those assets is prime territory for exam raters.
But what is the underlying philosophy here? Like, why bother splitting the gold between an issue and banking department? Isn't it all ultimately just RBI gold sitting in secure vaults?
Right. Why create this rigid accounting firewall?
Yeah.
Well, to understand the philosophy, you have to look back at the historical evolution of central banking, specifically the legacy of the Bank of England model and the Bank Charter Act of 1844.
Going back to 1844.
Okay. During that era, there was a fierce intellectual debate between the currency school and the barking school. They were arguing over how to manage a fiat currency system without triggering hyperinflation.
A valid concern.
Definitely. The legislative solution they developed was to legally and cleanly isolate the assets that directly back the physical currency in circulation from the assets used in the central bank's daily market operations.
Oh, I see. They created a structural firewall to guarantee public confidence.
Exactly. The sole function of the issue department is the issuance of currency. Its liabilities are the physical notes in circulation. To maintain absolute faith in those notes, those liabilities must be fully backed by specific, highly liquid, universally recognized assets, in this case, that 312.32 metric tons of gold, supplemented by foreign and domestic securities.
And banking department.
The banking department, conversely, functions essentially like a massive commercial bank for the sovereign government and other commercial banks. It holds the remaining 568.2 metric tons of gold as part of its general operational asset management strategy.
So when studying this section, candidates absolutely cannot simply memorize the consolidated 880.52 metric tons.
No, that will get them in trouble.
They must intimately know the split. 312.32 tons for the issue department and 568.2 tons for the banking department.
Examiners love to exploit that split. They will frequently provide the consolidated 880.52 figure as a highly plausible distractor option when the question is specifically asking for the issue department's exact holdings.
Speaking of distractors, we need to address the nil accounts.
Oh, the nil accounts.
The report explicitly highlights several specific accounts that carried a zero balance at the end of the operational year.
Let's list them.
Bills purchased and discounted, nil. Swap amortization account, or SAA. Nil revaluation of forward contracts account, or RFCA. Nil.
Which is notable because the RFCA was down from roughly 6,985 crore the previous year.
Right. So Why are these important?
These are the ultimate track questions designed to punish candidates who overthink the material.
How so?
An examiner will format a question asking, what was the balance of the swap amortization account as of March 31st, 2026? They will provide 4 highly specific, credible-sounding numbers, perhaps pulling figures from previous years or other minor accounts,
Right.
and one option that simply says 0 or nil.
But if the balances are zero, why does the RBI even bother cluttering the annual report with these line items?
Because they are mandated statutory reporting lines. The RBI possesses the legal authority to undertake the purchase and discounting of commercial bills to inject liquidity into specific sectors. However, in the 2025-26 operational year, they simply did not execute those operations. The statutory line item must be present, but the ledger balance is 0.
That makes sense.
The same principle applies to the SAA and the RFCA. They represent highly specific accounting mechanisms for forward contracts and swap operations that were either unutilized or entirely settled out to a 0 balance by the end of the reporting period.
It's insidious test design, honestly. You spend weeks memorizing 20 lakh crore figures, and the correct answer to a highly technical question is simply 0.
That's how they weed out the memorizers from the people who actually understand the operations.
Let's touch on the final few technical parameters before we wrap up. What is the status of the contingent liabilities?
So the total recorded for contingent liabilities is 11,159.19 crore.
Yeah.
For exam purposes, you must know the primary component driving that figure. It is the uncalled liability on partly paid shares of the bank for international settlements, or BIS, which are denominated in SDRs.
Let's clearly define SDRs, as that acronym often trips people up.
Yeah, good idea. SDR stands for Special Drawing Rights. It is an international reserve asset created by the International Monetary Fund, the IMF.
It is not a currency itself, right?
No, it's not. It is rather a potential claim on the freely usable currencies of IMF members. Its value is based on a basket of major international currencies.
The US dollar, the euro, the Chinese renminbi, the Japanese yen, and the British pound.
Exactly. And the BIS uses SDRs as its unit of account.
So what does uncalled liability mean in this context?
An uncalled liability essentially means the RBI owns shares in the BIS that they haven't fully paid for yet. It's a commitment to provide that capital if the BIS ever calls upon them to do so.
That perfectly clarifies the mechanism. Finally, let's document the statutory auditors, because those names inevitably surface in trivia-style regulatory questions.
They always do.
Appointed under Section 50 of the Act, the auditors for 2025-26 were Mrs. Sorab S. Engineering Co. and Mrs. Kalyani Walla in Mystery LLP.
Acknowledge the names, but prioritize your mental energy on the structural architecture. The issue versus banking asset split, the statutory logic of the 0 balances, and the nature of the contingent liabilities. That is where the deep analytical points are scored.
We have covered an immense landscape of central banking mechanics today. Let's organically synthesize the core architecture we've built.
Sounds good.
We began by dissecting the massive 20.6% balance sheet expansion, proving that the growth to nearly 92 lakh crore was driven by the valuation effects of gold and a depreciating rupee, not the physical acquisition of assets.
Right. And we tracked how those unrealized paper gains were quarantined in the CGRA to protect the integrity of the distributable income.
From there, we explored the income engine, demonstrating how the RBI harvested immense yields from the hawkish monetary policies of Western central banks, driving total income to 4.27 lakh crore.
Crucially, we dismantled the illusion of the 102.4% expenditure surge. We revealed that it was actually a legally mandated capital protection maneuver.
The denominator effect.
Exactly. The denominator effect forced a 1.09 lakh crore provision into the contingency fund to satisfy the 6.5% ECF target.
And finally, we followed the remaining liquidity down the statutory waterfall, past the tax exemptions of Section 48, resulting in a mandatory Section 47 surplus sweep of 2.86 lakh crore to the central government.
If you internalize the causality of these mechanisms, how a shift in global gold prices physically alters the ECF provisioning requirements, and how statutory firewalls dictate the ultimate dividend, you transcend rote memorization.
You achieve a practitioner's understanding of the central bank's operational architecture.
Exactly.
You're no longer just reading the matrix. You understand how the code is written. But before we conclude, we always like to leave our listeners with a broader theoretical proposition to mull over.
Something that stress tests the architecture we've just spent an hour analyzing.
Right. We've spent this session examining how a spike in global gold prices and a depreciating rupee massively inflated the balance sheet, creating immense paper wealth in the CGRA and forcing massive cash provisions into the contingency fund to maintain the ECF ratio.
But consider the inverse scenario.
What happens to the mechanics of the economic capital framework? If geopolitical tensions suddenly cool, global gold prices plummet, and the rupee aggressively strengthens against the US dollar.
That would invert the entire mathematical paradigm. The balance sheet would experience a severe contraction.
The CGRA would absorb massive paper losses as those valuations unwind.
Precisely. The denominator shrinks violently. So how would those cascading paper losses impact the RBI's ability to transfer a surplus to the government in the subsequent fiscal year?
If the balance sheet shrinks, does the ECF mandate the release of capital back into the income stream? Or does the volatility trigger a more conservative retention policy?
Understanding how the system absorbs immense paper gains is critical, but true mastery of central banking requires understanding how this statutory architecture withstands the shock of aggressive downside valuation unwinds.
That is a phenomenal analytical edge case to explore during your final review sessions. It forces you to run the accounting engine in reverse.
Highly recommend thinking that through.
Thank you for joining us on this exhaustive journey through Chapter 12. We wish you the absolute best of luck as you step into your professional examinations. Go deconstruct the exam.